Welcome, everybody. My name's Matthew. I am a co-founder of Toronto DAO. We have a very special guest. We have Luke from Figment. Very big in the staking services, and I can't tell you how excited I am for him to be here. Not just from like a the DAO perspective, but personally, just because I got to be honest. Bit of background story for me. I have some Ethereum. I won't go into too much details, but I will say I am terrified of staking. It's just sort of sitting there collecting dust. I am not happy about that. But I guess I'm rather it just kind of sit there and do nothing than lose it. And I'm sure that fear is irrational. Luke can tell me more about that. But yeah, so I'm very excited to have you here, and I'm selfishly going to get to ask all these amazing questions.
Awesome. Yeah, no, happy to answer any questions you have on that front. I think that's not I think it's like a pretty reasonable risk to have. And I think that, a lot of what we do here at Figment is really focused around, mitigating any of those risks and concerns that our customers have as much as possible. So yeah, happy to dive into that and anything else about company stuff.
Awesome, awesome. I don't like. I know Samir usually just come in and have the odd question, but I put you on the spot briefly. Do you stake any Ethereum?
Yeah, I stick Ethereum through Lido personally, just because I don't have I don't own like 32 ETH. I have like a pretty small relative amount of Ethereum, and so I just do it through Lido. But yeah.
Samir, what about you?
Um, what do I stake? Yeah, I stake Ethereum. Is there anything else? The rest is like some shit coin stuff, honestly. So I don't even remember what it was, but you did some cool stuff there. I actually wanted to ask, like, Luke, what exactly are you doing what do you do at Figment before we dive into questions?
Yeah, happy to jump in. So I mean, obviously, you guys are of course familiar with Ethereum staking. My role here is on the protocol strategy team, and so really what that means is, as I'm sure you guys know, in addition to Ethereum and Solana and all these more well-established networks that I think everyone here, most people here would be familiar with, there's also always new proof of stake blockchains launching. And certainly I think over the last 2 to 3 years, we've just seen the number of networks launching just explode. I mean, there's so many going live right now. And so a big part of what we do on my team is scoping out, of all of the new networks launching, which are the ones that we're going to prioritize support for, right? I mean, despite being one of the larger validator companies in the space, the reality is we only have, so much resources to allocate. And so we have to be selective about the networks that we choose to support. And so a big part of my day to day is, really doing pretty deep research into all of the new networks that are coming to market and determining which ones we want to be like day one supporters of, or in some cases we'll support them a little bit after they go live. And so, yeah, there's a big research component, but also I'd say my team works pretty much across the entire company to sort of provide that kind of expertise on the newer networks that are launching. So mostly focused there.
That's awesome. That's awesome. And yeah, like I said, I'm very excited personally. I'm super happy that I get the one to ask the questions, because these are a lot of questions that I've wanted to ask someone in your position for a very long time. So I feel like it didn't take me a long time to come up with these questions for this space, but because I've been thinking about these questions for probably a couple of years.
Matthew,
So
I don't remember you ever being so excited. So I'm now excited for
well,
you
I
too,
mean, my
Matthew.
Ethereum's just kind of sitting there doing nothing, right? And that's not fun. I'm pretty much leaving money on the table. Who likes to do that?
All right. I'm just saying this is an interesting one. Okay, I'm
Okay.
gonna be quiet now.
All right. So, can you tell me about some staking services that you provide at Figment? Let's start with the basics.
Yeah, happy to. So just to give a brief overview on Figment, we are, we're a validator, or I guess a staking service provider, you would say, meaning we run infrastructure for, like I mentioned, a whole bunch of different blockchain networks. And generally, our biggest focus is on like enterprises and institutions in the space. Those range from crypto native asset managers and people closer to the traditional finance side, and also, of course, a bunch of just crypto native companies as well. And so in terms of the services that we provide to them, I think there are a number of these. I think that the most obvious one, and one that you may have come across yourself if you're staking or if anyone else in the space is staking, is just public validator nodes. So if you go on the block explorers for any of like the newer networks, certainly like Business SDK based networks, you'll see Figment nodes on quite a few of them, certainly on anything that we're operating on. And so if you're, obviously this is not the case on Ethereum, Matthew, but on most delegated proof of stake networks, you'll be able to just stake to a professional validator or community validator, delegate your tokens there. And so we offer that service to, anyone can access that, but that's definitely something that we offer to our larger clients as well. In addition to that, we offer white label validators. And so this means is if you're a company and you want to offer validation services and you want it to be like branded with your name, we enable you to do that. And we just run the infrastructure on the back end so that you can have, specialists handling the more, I guess, like we're handling the operation of the infrastructure to mitigate all of the concerns that you mentioned, right? Around like, okay, am I going to get slashed? Like if you're a company that wants to offer that, you can outsource that to us as professionals and just offer the service to your end clients. In addition to that, we work with liquid staking protocols like Lido, which I imagine you're familiar with, as well as restaking protocols like Eigenlayer, if you've heard of them. And the work that we do there is relatively similar. We run infrastructure for those restaking protocols. Ultimately, that ends up securing, you take one base asset, whether that's ETH or SOL, and then you're securing a number of other networks that are tapping into that same economic security. So happy to double click anywhere there, but I'd say that's like a pretty good high level overview of all of the things that we do here at Figment.
So that's really cool. I was about to ask you if what you're doing is different than liquid staking, but you kind of sort of answered that already by saying that you work with these things. Can you elaborate more on that?
Yeah, more than happy to. So the way a liquid staking protocol works is if you're going to go deposit ETH into Lido at a very high level, you deposit ETH to the protocol, and then that ETH does get staked at the protocol level, right? And for any of these major liquid staking providers, they're going to have a number of infrastructure providers that they work with to distribute the stake across. And so the way that we work with those providers is we're generally partnered with them to run infrastructure on the back end so that when a customer deposits ETH, they get their stETH, and then that ETH ultimately ends up at either a Figment validator or a different partner of theirs, and is staked, and that's where the yield comes from for liquid staking. So in terms of like the difference between the two, for anyone who's not familiar, protocol staking happens at the base layer of the protocol. It almost always, although not in every case, requires you to lock up your assets for some period of time, which varies from network to network. And in that case, you're staking your assets directly to a validator. Like I sort of touched on a little bit earlier there, liquid staking is really something that's built on top of protocol staking, meaning there's still protocol staking that happens when you're liquid staking, but the liquid staking protocol itself sort of abstracts that away. And what that looks like is you'll deposit your ETH or SOL or whichever asset it is into the liquid staking protocol, and then that protocol will issue you what's called a receipt token. So if you've ever seen STETH, that's Lido's of staked ETH. There are a number of other liquid staking protocols across a number of other chains. But yeah, effectively you'll deposit your ETH, the liquid staking protocol will stake that to a validator, and then you'll get the liquid representation. And that liquid representation of the staked asset, earn yield on that, you can then go and use it in DeFi. So if you wanted to deposit it in Aave maybe, and then take a loan out in stable coins to go trade some meme coins, or any number of different things. Or if you just wanted to swap it into a different asset without having to wait for it to unstake, you could do that. So it gives you a little bit more flexibility while still allowing you to earn some yield from staking.
So I guess my next question is sort of really irrelevant because or I guess I'll change it up a bit. What would be the advantage of using Figment versus just using Lido directly?
Yeah, it's a great question. So in this case too, I'll speak generally because I think on Ethereum, for example, you have the 32 ETH requirement to run a validator, which is a hurdle for a lot of people and kind of I guess like in that case, one reason you might use liquid staking is you just don't have enough of the underlying asset to be able to stake directly to a validator because you need more to run a validator. But speaking generally, assuming that like a lot of, I would say outside of Ethereum, the vast majority of chains you're able to stake at the protocol level with minimum requirements, right? Like 1 or 2 tokens. So just speaking very generally in that context, I think at the end of the day, it really comes down to 2 things, one of which is risk and one of which is cost. So to start with risk, like we talked about, if you're staking through a liquid staking protocol, your assets are still being staked. So you still have all of the standard slashing risks that companies like Figment help to mitigate, right? Like if your validator were to misbehave in any capacity and commit a slashable offense, you could lose a portion of your deposit. What's unique with liquid staking is because there's an additional layer built on top of that protocol staking through using smart contracts, there is some additional layer of risk there where if something were like if those smart contracts were to be hacked in any capacity, for example, depending on the design of the liquid staking protocol, there are a bunch of different like levels of risk that could incur. And obviously for things like Lido, those are very battle tested contracts, but it remains the case that like no matter what, if you had additional complexity to a system, there is going to be additional attack surface, no matter how like mitigated it is. And so that's on the risk side. And I would say that's especially, like with newer protocols as well, potentially like on, a lot of them will port over code that has been more battle tested, but the newer something is generally like the more theoretical risk there could be, right? And so by staking with Figment, you know that you're taking the minimum amount of risk possible while still getting the yield on those assets. But of course, you give up the benefit of having those assets liquid and able to use them throughout the protocol as you see fit. And the other piece is cost, and this is something that it varies quite a bit depending on the specific protocol and also just the rates you're able to get from your validator. But because of the fact that if you're staking through a liquid staking protocol, they will typically take some form of fee, right? They're providing a service, they'll take a fee. And then of course, a validator also has to take a fee for their services. And so in some cases, it may be more costly to do liquid staking than to do native protocol staking, but it really, in that case, depends on a lot of different factors. So those are like the 2 major things that I think I would call out.
That's really interesting. And yeah, it does make sense that if you use like Lido, which has been around since even before the merge, versus something that came out tomorrow, I'd imagine there'd be a lot more risk than that. I don't think Lido has ever actually had a slashing incident. I don't know if is that true? I don't expect you to know that. I'm just
Yeah,
curious.
to my knowledge, I don't think so. But there's the slashing incident, which just happens at like a validator by validator level, right? And so that's the kind of thing where like, you know, I don't know off the top of my head the exact number of providers that Lido works with, but for any of these liquid staking protocols, right, it's possible they could do their job perfectly well. And if one of the infrastructure operators makes a mistake, there could be a slashing event that isn't, that isn't really the fault of the liquid staking protocol, right? And I imagine many of them have, a backstop to protect customers in that event. But I think the thing that really, like, where the additional theoretical risk really comes into play is in the smart contracts, because that's like the product of the liquid staking protocol, right?
Yes, that's a good point. And that perfectly segues into my next question. And the reason why my Ethereum just doesn't do anything, I have a huge fear of slashing.
Mm.
I stake other stuff, like I have stakes. I have been slashed on a couple other coins, but like I think I lost like $10 total to slashing, where I've made a lot more than that. But I've seen this could all be fake, and I've seen people lose like all of their Ethereum. I know that's rare, but like, I guess that's my big fear. Is it possible for you to explain slashing in sort of a non-technical way? And like, what's a likely outcome if you're slashed? Are we talking about like a quarter of an ETH, or like, I mean, a percent of your ETH, or like all of it?
Yeah, no, good question. Happy to dive into this here in non-technical terms for you. So to start from like the very top, just to make sure I'm not sure what everyone's like, background is here on staking, but validators on a proof of stake network, their job is to run specialized infrastructure that secures the network. and validates transactions as they propagate through the network. Because running a validator is, in almost every case for public blockchains, a permissionless thing, like anyone can do it, the network itself generally needs some way to ensure that validators are going to act in the best interest of the protocol as a whole, right? And the way that that's accomplished is through economic incentives. At a minimum, validators are going to have to perform their duties correctly within some margin of error, right? To earn rewards. Like if a validator has like half a second of downtime, generally speaking, that's not a big deal. That's just something that happens when you're, running infrastructure. And so that's not going to come with a huge hit. But like if you're a validator and you have downtime for like multiple days, you're going to at least most likely, in a lot of cases, miss out on rewards. Now, slashing is sort of the other side of this. Many, but not all protocols will implement, and this acts as an economic disincentive for like overtly malicious behavior. All protocols have different criteria, and many of them, especially newer ones, will launch without slashing initially, or they'll have some there's a bunch of different mechanisms that cause slashing. Some are automated, and some are on newer protocols, sort of just like consortium based. But the idea here is, if slashing is effectively the economic disincentive for doing something that is overtly malicious. So one good example is if a validator double signs on a block, meaning like say you're on block 100 of the chain, and a validator signs off on multiple different blocks for block 100, that signals to the network that there's a decent chance that validator is effectively doing something that could damage the integrity of the network. And so that's the kind of thing where on networks with slashing, you will usually be slashed for that. The exact amounts that you'll be slashed for different infractions will vary from network to network. And unfortunately, like given the fact that I'm spending most of my time on the new network side, I'm not probably the best person to ask on the exact amount that you'll be slashed for different types of infractions on Ethereum. We have, an Ethereum protocol specialist, or a couple of people here who could go like really into the weeds on the details there. But yeah, at a high level, what slashing is a way for the protocol to penalize a validator for doing something that is likely malicious, or and to be clear, like validators, infrastructure operators, it's possible to, for example, for a validator to double sign without intending to be malicious. And really, like the role of the institutional operator is to have the kind of systems in place to ensure that the possibility of that happening is minimized to the extent that it's possible to be. And so Figment's never had a double signing slashing event like that. And I think that owes a lot to, some really specialized setups that we have that make sure that possibility is mitigated to the largest extent possible.
That's really interesting. Do you provide insurance as well? Because I know there's some places that do provide some insurance for a cut of this rewards.
Yeah, we do. I don't, off the top of my head, I don't know what like the exact specifics of the policy are, but I know that Figment provides some degree of insurance for missed rewards and slashing. And I think that we also work with a number of, or our customers are able to work with a number of other third parties too, if they want to get like an additional layer of insurance beyond what we're able to provide. But to answer your question,
Good stuff. Yeah, that definitely does, and especially that insurance part. I don't know if Samir had that same fear. He's just like, meh. I'm overly cautious.
Well, yeah, I think if I knew somebody who were slashed for like their entire stake ETH amount, I would probably also be pretty concerned.
I don't know anybody personally, but I've seen like Twitter stories. That's why I don't know if it's fake or not. But that's been like, oh my god, I'm not doing this.
Yeah.
I know, like you said, some blocks, and I know you're with newer blocks. A lot of what's it called, Cosmos type blockchains. I think the average unstaking time is like 3 weeks. And you have like BNB, which I think is a week. Solana is a few days. Do you know what's but I know Ethereum does fluctuate. I know like depending on the day they could change. Do you happen to know what the average unstaking time is for Ethereum?
Yeah, the average unstaking time, like, and you alluded to this sort of earlier, it's hard to give like an average unstaking time overall, right? Because different networks are very different. In terms of Ethereum, you're right. There's this exit queue mechanism that, really just the thing that will dictate how long it takes to actually exit a validator is just how many validators are trying to exit or enter the set. I know that right now it's about 16 days. I think that's a little bit higher than it typically is. Off the top of my head, I don't know like what you would call the average, right? Because it would also depend on like over what period of time are you taking the measurement for the average. But right now, if you wanted to exit an Ethereum validator, it would be 16 days.
All right, that's not so bad. It's sort of like in between, like Solana and Cosmos, basically.
That's right.
I remember it being pretty ridiculous. Like during the merge, we were talking about like over a month and a half.
Mm-hmm. Yeah, I think like in that case, you had a back, like to your point, right? Lido launched pre-merge, and so there's probably a backlog of a number of people who wanted to unstake after that event, and weren't able to exit, in real time as they wanted to, effectively. But yeah, it's really it's a function of like what the demand is to exit the network, right? And when the demand to exit is lower, the execute presumably lower.
Yeah. So down to the rewards. Right now, the rewards like they're around 3% ish, more or less. But I've read that they can go up to 18%. So like, what causes for such? Why would it be 18%, and why is it now 3%? I guess like what causes this fluctuation in rewards?
Yeah, no, so it's a good question. So there are a number of factors that affect this. I would say the two most significant ones are one, the amount of ETH that is staked, right? Because the network is going to pay some amount for people who are securing the network, and that amount can fluctuate to some degree based on how many people are securing the network. But it won't fluctuate to the degree to keep up with a bigger factor in that equation is just how many people are staking, how many people are after a relatively fixed amount of rewards that are being distributed, right? When I say relatively fixed, it's like it will be in some range, but the range isn't big enough so that no matter how many people stake, they can all earn 18% in ETH, right? So that's factor one. And then factor two is just the amount of activity that's happening on the network, right? So when you're staking, there are a number of different sources of rewards. Some of that is just ETH that is being pushed out by the protocol as like a reward for stakers. But another really significant component of it is priority fees. So I don't know how many of you guys very active last crypto cycle, but certainly like when NFT mints were going crazy, people would pay 200, 300, even more at times dollars in ETH just to get their transactions landed on the chain. And so the bulk of those kinds of transactions, or not the when you're paying that much in transaction fees, a portion of that's a priority fee, and that's getting paid to validators. And the other thing is MEV. And so when there are like liquidations that take place on lending platforms, validators are able to capture that by working with specialized entities who will effectively, bundle up transactions in a way where they're able to extract a profit and then effectively pay validators for including that bundle of transactions in a block. And so all of those activity-based metrics ultimately drive revenue for validators too. And so today, right, with ETH at like 3%, you really have a confluence of factors where there's a lot of ETH staked, and there's also much less activity happening on the network than was the case, say, last cycle. And I'm sure, a lot of people have seen Solana really like taking center stage for a lot of the cycle as sort of the chain where a lot of the more speculative activity is happening. And that type of speculative activity really drives a lot of revenue. And so of those two parts of the equation, like the revenue side is lower than it has been historically. And also the number of people are staking remains relatively high, which sort of gets you to that place where the rewards are relatively low compared to the level that they theoretically. If you had a ton of people on stake and then network activity pick up a ton, then you would see the staking reward rate increase, higher. I don't know that I think to get to 18%, you need a really extreme set of circumstances. But it would certainly, rise from where it is today.
Yeah, who else remembers, $50 fee just for making a swap on a DEX?
Yeah, no, it's crazy.
You had to really want that token or NFT, and like as you said, sometimes it'd be several $100s.
Yeah, and the worst part is sometimes it wouldn't even go through. Like I don't know if this has happened to anybody, but I remember the last time I don't know, I think I was minting an NFT or something, and you'd pay like $200-300 in gas, and then you find out that actually like the NFT had minted out in the time that it took that transaction to complete. But of course, the network still has to charge you
Oof.
for sending an action to the chain. So then you're out $300 and you didn't even get what you wanted.
That's rough. That's rough. I've never experienced that. I have heard of people like their transaction failed and they still paid like the $50 to $100 fee. And but yeah, what you describing, I can't imagine. Samir, have you ever gone through that yourself?
I don't think so. Maybe like I probably lost like $5 on something like that, but never like
Ooh,
$200.
not a big ETH user then.
Yeah.
$5.
It
So
was a lot as well,
let's.
not 8, but yeah.
So do you mind if we do like a quick like walkthrough? We'll use Ledger because that's possible. How can someone with a bunch of ETH stake stake it up with Figment on their ledger?
Yeah, happy to. So if you want to go through Ledger Live, I imagine you're familiar with Ledger Live, right? It's like the software that
Mhm.
comes with Ledger, helps you set up. You just go into the Discover tab on Ledger Live, and in that Discover tab, we actually have our own app in there. And so you'll be able to, if you go into the Discover tab, you can search Figment, and then if you click into our app, you'll have the ability to stake ETH directly through there, and you can make that transaction with your Ledger through Ledger Live directly.
Oh, simple as going on Ledger Live, signing the transaction, you're good to go.
That's right. I mean, you will need the full 32 ETH to be able to do that. But assuming that you have sufficient amount of ETH, yeah, you can just do all of that directly through Ledger Live. So nice and easy.
So what do people do if they have 5 ETH?
Yeah, I mean, with 5 ETH, I think a lot of that kind of side of the market tends to skew towards liquid staking. A lot of cases, but yeah.
Can they use like? Do you provide services for like? I guess you would help them with the. You say you use the liquid services, so people like with 5 or 6 ETH would guide them through that.
Right. That's generally what we would direct people to do. And of course, like, not all of the ETH that ends up going through liquid staking services ends up with us, but like, we and the other partners of the liquid staking providers will, be running the nodes for some of that. And so we do have products that we offer to some of our enterprise customers that allow them to offer sub 32 ETH staking to their users. But you will need that's not the kind of thing, because of the way that it's designed, it's not the kind of thing that like any regular user can come in and just deposit 1 ETH into. So we have products that enable that, but they need to be used by an entity that has the 32 ETH backstop as well. If that makes sense.
Yeah, and I should mention that there has been talks of lowering it to 1.
Mhm.
So maybe in the future, the 32 ETH is not going to be an issue for most people. Maybe that's just what I've heard through the grapevine.
Yeah. No, I think there are definitely discussions ongoing about that, and I think if you look at any other proof of stake network, ETH is pure proof of stake, whereas most new proof of stake networks launching are delegated proof of stake. Most of those delegated proof of stake networks have very accessible minimum requirements to be able to stake, and so I think it would be like net positive if they moved that direction. But I know there's like a lot of priorities on the Ethereum roadmap. So
Yeah, I do like. I won't speak for Ethereum, but that's a lot of money. I imagine
yes,
that's almost $100,000, right? Something like that,
yeah,
depending on the price.
it's close to that for sure. And I mean, I will say too, like on other protocols, generally speaking, like the biggest the reason that's the case on Ethereum is that's the minimum to run a validator. On most other protocols, actually, to get a validator into the active set are more in terms of US dollars than that. The difference is, as an individual, you can just go and delegate to a validator, whereas the way that Ethereum has it set up, at a protocol level, you can only run your own validator. They don't have delegation. And so that's where Lido, I think, really, Lido and other liquid staking providers really come in and, sort of provide access to that, but at the app layer rather than at the protocol layer itself, as is the case on most other chains today.
I remember like if ETH this was like before COVID, and like ETH was like $300. I'm like, that's an insane amount of money. 32 ETH.
Yeah.
Wow, did I know so little back then?
Yeah. No, it's ETH's unique in a lot of ways for sure. But be interesting to see how that trends over time if they end up moving forward with one ETH minimums.
So, like, what's next on the horizon for Figment? I've noticed there's a lot of job openings, and usually that means there's going to be growth happening.
Yeah, no, definitely. I would say that as a company, we are very much showing growth mode these days. In terms of what's next for us, I mean, happy to speak to some of the things that I'm seeing a lot in my day to day on like sort of the on the new network side. There's a number of things that we're really excited about here that are sort of new unlocks in the staking world more generally. I would say the two biggest ones are Bitcoin staking and also restaking. And there's some overlap between the two. I'm not sure. Are you familiar with Bitcoin staking at all? The fact this is a thing now.
I've seen it being thrown around, but I've been like, how, and that answer of how has never really been answered for me.
Yeah. No, it's understandable question because obviously Bitcoin itself is proof of work. But we're starting to see more networks. I think like the one that's generally most well known by most people is Babylon, um, that enable Bitcoin to be used to secure other networks, whether those are L2s or proof of stake chains. And so Babylon itself is going to be its own Cosmos SDK layer one. And the way that works, again, very high level, is there's a staking contract in quotes you can develop on Bitcoin itself using Bitcoin scripts that locks your Bitcoin and enables it to be slashed. And then the Cosmos SDK chain that Babylon's built acts as a sort of, I guess, control plane that you can think of where you stake your Bitcoin on Bitcoin itself, assign that Bitcoin to what's called a finality provider, which we operate, and functions kind of similarly to a validator in that finality provider gets some amount of Bitcoin stake assigned to it. We operate infrastructure for these other networks, including Babylon Chain and any other network that wants to opt into Bitcoin security. And then in that case, we secure the Babylon Chain, we secure all of these other networks, and you're able to earn yield from all of the networks against your Bitcoin stake.
Wow. I'm not gonna lie, did not understand everything you just said. But I kind of got that how it would work, and it's just crazy what people can come up with, right? We have one of our co-founders. He's working heavily on the Bitcoin space now, and I feel like he would understand that way better than me. He's big on ordinals and everything, but that's just the fact that you can stake Bitcoin is incredible. Did you know that, Samir?
Brother, you just say your thing, man. I am like taking notes. I actually like, for me personally, like it was also it was a cooler thing to stake Bitcoin just because I have more Bitcoin than Ethereum, so might as well put it to use, right? So that's where I'm like, okay, this sounds interesting.
Yeah, exactly. And I think that's one of the cool unlock there is previously in order to be able to get yield on your Bitcoin, you would have to, potentially like lend it out to somebody and they're paying you an interest rate and then you have counterparty risk. Whereas, while Bitcoin staking obviously does not, it's not like the protocol, it's not the Bitcoin protocol itself that is paying you for staking your Bitcoin. Staking is the kind of thing where your risk profile is really just translated to, are you working with a very competent operator? And so that's somewhere where it feels like a natural fit, of course, for our business to be involved there.
Yeah, so it's like if I have some Bitcoin to stake, I'm like, I'm gonna go with Figment just because they're a respectable company and I trust them, and it's just like it's better to go with them than just some random offshore type of entity.
Yeah, exactly. I mean, that's certainly what we aim to provide.
And Samir, I'm definitely going to be asking for those notes later.
Yeah, and hey,
we'll transcribe the whole thing.
I will also plug, we have a number of articles on our website diving into the details of how Bitcoin staking works in a much more detailed fashion, and if I'm being honest, probably like much clearer fashion than I can go over like in real time. I feel like, at least it's certainly for myself, like I need to read through the docs a number of times before the stuff really clicks for me. And we've done our best to kind of distill that into something that's a little bit more accessible for a broader audience on our blog. So definitely feel free to check those out if you're interested.
Definitely will do that. Thank you for plugging that in. So is there anything like Web3 projects can do to get involved with Figment? Like, do you reach out to them? Do they reach out to you? Or are you just keeping it closed for now?
No, absolutely. I mean, we're happy to work with really anyone. In the crypto world, there's a number of different ways that we work with people. I think the easiest one is if you're a company that has any treasury assets, whether that's ETH or Sol, and like we talked about now, Bitcoin, and you're looking to earn a yield on that. You know, always happy to set up some time, chat with people to see like how we can work together to find like basically enable them to get the type of yield that they're looking to get through staking. I think the other thing, and we talked about this a little bit too, is if you're a liquid staking provider or a liquid restaking provider, generally speaking, those protocols want to work with professional operators in the back end to make sure that they're providing the best like protocol layer staking services to people that are holding their LST. And so we work with really a very wide range of the protocols that are offering that, again, across a number of different networks in crypto. So if that specific subsegment of Web3 companies we work with quite a bit. And then, also on the white label side too, like, if you're anyone in crypto or even outside of crypto and you'd like to run a validator, brand it as and be able to offer that to your customers, but work with us in the back end, we're happy to take care of the infrastructure side there as well. So those are the main ones that I would call out. But there's definitely some other like longer tail things we can think about on like a case by case basis too. So safe to say though, like I think pretty much anything that touches staking, restaking, Bitcoin staking on protocols we support, like we can work with people there.
That's really cool, and here at Toronto DAO, we always like to work with so many people. I know like you're not in charge of this, but like we noticed that there's a event posting, a job event host to be based in Toronto. Whenever that job position gets filled, we'd love to get in touch with that person, and maybe we could work something out and host a fun event together.
Yeah, no, absolutely. And I think as you guys know, we're a Toronto-based company. I personally work out of our New York office, but we have a pretty good cohort of the team there, and definitely happy to put you guys in touch with the right people.
That's awesome. That's awesome. I would like to sort of segue that just do a selfless plug here. We're having our own events. I believe it's the 20th. Samir, can you confirm the date? I don't have it in front of me.
Yep, February 20th.
February 20th. We're having it with Walrus Protocol. It's going to be a lot of fun. There's going to be drinks. There's going to be food. It's at a new venue. It's sort of like this cool. It's not a restaurant. It's not a. How would you describe it, Samir?
Professional offsite venue for corporate events.
Yeah, it looks really classy, high end. So I'm really looking forward to seeing this. I think it's going to be a lot of fun. For those who attended our last events, it was jam-packed. It was so exciting to see all these people learning, asking questions. I learned a lot. And yeah, I think this one's just going to be a lot of fun. And I love hosting these events, and I can't wait to see people there. Just make sure to register on Luma before space fills up, because space is limited.
Awesome. Yeah, appreciate the plug. I will definitely let our Toronto based cohort know.
That's good. Do you mind if people ask their own questions?
Yeah, please. You're more than welcome to fire away.
So yeah, I see someone here asked to speak, and I didn't bring him up. Just I wanted to get through before we did that.
Yeah, of course.
So sorry, Slipstreamer. I know you kind of were on the limbo for a while, but I have invited you to speak. I know someone asked me to ask a question. Slipstreamer, you're here. How's it going?
Hey man, pretty good. Thanks for hosting the session. It's been really informative.
Slipstream, how are you?
Good, thank you, thank you. Yeah, I've been staking for a little while now myself, and yeah, I think you kind of spoke to this question already, Luke. But it sounds like um, Figment kind of determines which protocols to support based on like demand, and it sounds like there's obviously a demand for Babylon as well.
Yeah, absolutely. Happy to. I also, I'm sorry, I'm seeing your question that you left as a comment here now as well. It's just how do we decide what to support as far as new protocols go? I would say there's a number of things that factor in. Demand obviously is a very big one. We as an institutional staking provider generally have pretty close relationships with most of the bigger investors in the space, as well as a lot of the custody providers. And there's the pipes, so to speak, that are required to support staking for these larger investors who are generally working with custody providers is something that is like a pretty big factor for whether we're able to work with customers or not. And so there's sort of, in addition to just what kind of demand do we have, it's what kind of integrations are we seeing across the partnership side, which are the bigger investors that we work with are involved in the protocol. And then also the other thing that of course is very big is like for myself and also for our team lead Drake, there's a process that we go through to sort of develop conviction around the network as something that we believe will be valuable today and also out into the future, right? And obviously crypto is still a very nascent industry, so all of these things are very new, and not everything will end up becoming like the next Ethereum or the next Solana. But for us, it's really important that we're supporting the growth of the networks that we think really have a chance at that, so that we can be early supporters there at day one, and yeah, just be good stewards, I guess, of the industry and good infrastructure providers to help support the growth of the space as a whole.
Got it. Thank you. And if I could, just one more question, and I've kind of had this question myself as like a retail staker on Solana. Is I look at some of the top validators or the top validators with stake on Solana, and it looks like Helios has the most stake. But also, I assume this is because they don't charge a validator commission, whereas others do. And you kind of mentioned like I know slashing is not really a thing on Solana, but is there any kind of like benefits of going with like a Helios, just like standard validator, or delegating to Figment specifically?
Yeah, no, it's a great question. I mean, I can definitely speak to the fact that, I'm not sure where Helios stands, but I know we are among the top performing validators on Solana. And I think the other thing too is it comes down to just a different business model to some degree as well. So there's this thing on Solana called stake weighted quality of service, and I know that a big part of the reason Helios is able to offer those 0% fees is that they're, as I understand it, able to, like, the more stake you have, the more you can sell higher probability of having transactions landed in blocks. And there's certain actors on networks where that's something they're willing to pay a lot for. Like certainly we talked a little bit about MEV. If someone's looking to extract MEV, priority access to block space is very valuable. And so on our end, it's something that we are, we're evaluating that side of things, but it isn't something that we've moved forward with in a big way thus far. And that, like, for us, the fact that we're still trying to figure out exactly the right way to approach that, especially just from a ethical and compliance perspective, it means that we need to take fees. Like I don't know exactly what our commission rate is on Solana today, but we need to take some kind of a fee off the top. And so it really just, in that respect, right, as a retail staker, like if 0% commission is really, really important to you, then like that's not something that at least today we're able to offer. But for certain clients as well, they have different priorities around like other aspects of operating infrastructure, I would say.
Got it. Thank you.
Yeah, of course.
Oof, good question. Good question. We got someone else asking a question. We're having some technical difficulties. He asked me to ask him for you, but you kind of already asked this. Um, so like, what are the like ballpark fees that you have if some of these institutions they want to get in touch with you? Like, is that something that you negotiate, or is that like a flat fee?
Yeah, it's a great question. It's definitely something that we can negotiate, and generally speaking, that negotiation just comes down to like, what kind of I guess volume, for lack of a better term, or size are they going to be staking with us, right? Like, as is the case, I think with pretty much any industry to some degree, like if you're a buyer of the product, right, which in our case in validation services, and you're willing to come in with larger demand, then generally speaking, you can negotiate around the right price. And so it's definitely something that we do with our larger customers. In terms of what the exact amount is, that varies a lot for a number of reasons, right? Like some networks are much more expensive to run validators on than others. And so that's a factor. Another factor is like, what is the staking reward rate on the network, right? Is the network paying 1% or is it paying 10% rewards? All those things sort of factor into the way that we think about negotiations. And it's hard to give like an exact range of what that ends up being. But certainly if you're a customer coming in with a significant amount that you're looking to stake, set up a time to talk with our sales team and find a price that works for both of us.
Polar Ventures, I see you finally got the speaker role. Did that answer your question? Do you have a follow-up?
No, I think that answers most of the questions. So the other part of the question I had was that are there any base fees that you have to pay upfront in order to get integrated into the platform?
Sorry, when you say get integrated, do you mean if you're somebody looking to stake?
Yes.
Yeah.
Let's say if you're looking to offer staking services to your users in your DApp.
Oh, I see. Yeah, that again, I would say that also depends. You're talking about kind of. Oh wait, sorry. In your DApp. This like so just to answer your question, like I'll go kind of top level to start. For white label validators, there are sometimes like fixed kind of fees that we will ask for someone to cover, just to cover like the operation of the infrastructure. If you wanted to integrate Figment into your DApp, assuming I'm actually honestly I'm not sure on the answer with that, and I think ultimately it would come down to like, is there work required on our side to help support that integration for you? If that is the case, then it's like more likely there might be fees involved. But if it's something where you're just looking to, support Figment in your DApp and it's relatively light lift for us to sort of just give you what you need to integrate that, I think that's something that generally the fees would be lower. But unfortunately, I don't have a great answer to that one way or another. There's like other teams within the company that would probably be better to talk to about that. But if that's something you're interested in, happy to chat and just see if we can be put in touch with the right people.
Sounds good. And my last question would be, have you had any security incidents?
Yeah, so like I mentioned, Figment has never. What I know is that Figment has never had a double sign slashing event. In terms of, I'm relatively newer at the company. I've been here like less than a year. In the time that I've been here, there haven't been any major like security incidents. So to my knowledge, no. But also, I think would depend on exactly what you define as a security incident.
Mm-hmm. Mm-hmm. Okay, sounds good. All right, thank you so much.
Yeah, of course.
Thank you, Polo, for the question. Good question. We're coming down to the end. Before I open it up for any more questions, I do want to say we do have a Zeely campaign because we like to keep track of all those who participate in the DAO because we are a community DAO. The quest is the name of the quest is Figment Spaces. It's sorry about that. I just name of the question is Figment Space, and it's just a simple ETH32 for the code. No caps, all one word. So I just want to get people to be able to participate in that. For those who are listening live and those who listen afterwards. Yeah, this has been great. Is there anything more you'd like to add, Luke, about Figment?
No, I mean, I think the main thing would just be, if you're listening to the space, either live or later, and any of this sounds interesting to you, certainly if you're like a Web3 business or maybe your new protocol launching, like to get in touch with us, by all means, feel free to reach out. We're always looking to, speak with anyone we can help with on anything. So just let us know.
Awesome. Yeah, and let us know when you want to do Toronto events. We're happy to partner with people, and we'd love to have a Figment event here in Toronto. There are lots of excited people here. The crypto community continues to grow.
Yeah, no, I definitely get that sense. I've actually never been out there myself, but definitely, I'm sure at some point we'll make my way out to the Toronto office, so we can meet up with you guys then, and for sure we'll make sure that you're in touch with our events people if there's anything upcoming, maybe we can work together on.
Perfect. Looking forward to it. But yeah, we're just about to run out of time here. Thank you so much, Luke. Thank you so much, Figment, for agreeing to be part of this incredible space. I learned so much, and I can't wait to check those articles out you mentioned. And I'm probably gonna rewatch or re-listen to this space myself just to make sure I got everything correct. My name's Matthew from Toronto DAO. We have our weekly space, and I hope everyone has a great weekend, and I see you all next week.